This is level 2 of the CFA program, the topic on economics and the reading on economic growth and investment decisions. Remember back in financial reporting and analysis where I told you that the Institute does not require us to be accountants, but they ask us to think like accountants so that we can become better financial analysts. Well, the same principle holds true in this reading. The Institute is not asking us to become economists, but they're asking us to think like an economist so that we can become better financial analysts. And it's a good thing, too, because the author of this reading is a gentleman who has a PhD in economics, but also holds the CFA designation. And so this reading is a great marriage between what we need from the economics literature regarding economic growth and then how we can apply it. That's the second part, the investment decision. So let me give you just a brief introduction here. So what do we know? We know the economy can be measured, let's suppose it's this size. We know the economy can grow. We know the economy can contract. So when economies are growing, what does that mean? That means that there are increases in available positive net present value projects for companies, not just domestically, but globally as well. And so as good financial analysts, we need to identify those companies inside of the positive net present value framework so that we're better prepared to make these investment decisions. And those investment decisions could be, of course, wealth management or asset allocation, or something even more complex, regarding the use of derivatives or maybe alternative investment strategies. But the point here in this reading is that, all right, before we can make those investment decisions, we need to know something about the macroeconomy. We need to be able to predict economic growth. It's one thing to say the economy is this size today. But if we're smart and we use all of the skill sets that we're learning here, we have a better idea of what that future economic output is going to look like, which then makes us more efficient financial analysts. And you'll see that as we go through these learning outcome statements. So look at that first one. Factors favoring and limiting economic growth, long run rate of stock market appreciation, potential GDP, forecast potential GDP. And then the Institute throws a really interesting section in there on natural resources and population. And then we'll end with a brief conversation on trade barriers, but there's probably an important one in there. Notice the second bullet point there on LOS's compare classical, neoclassical, and endogenous growth theories. I think that's going to be an important one as we go through. But also note that technology, the word technology, appears in a lot of these LOSs. And you'll see what I mean here in just a second. Oh my gosh, there's another technology right in the middle of this slide. So a brief recap. Economic growth is the increase in the production of goods and services of a country over a specific time. All right, that's the economist language for what I was saying earlier, is that these companies out there are finding positive net present value projects at the micro level. And when you aggregate all those micro level increases in positive net present values, you get economic growth. Indicators of economic growth, right? The amount of stuff out there. There's a picture of a dump truck. That's a good one. Technology, human capital. I always think of human capital when I look at my children as their brains and as their brains develop. When they were little, they had these little teeny weeny brains. They couldn't really do a whole lot. And as they grew, they increased their capacity for decision making and wisdom and all that kind of stuff. I'm sure those of you who are parents can understand the importance of the increase in human capital, the ability to solve a problem. When my children come to me and say something like, "Hey, Dad, what's going on?" I say, "Well, I can help you, but why don't you figure it out?" The old figure it out is really a great parenting strategy. Of course, sometimes my sons make decisions where I think their brains are about the size of a pea. And then growth in labor force over there. So this is probably a good recap from what you learned back in level 1. So let's go ahead and start with this first super simple LOS, factors favoring and limiting economic growth. These couple of slides I'm going to call, hey, I bet you remember this because this is super common sense. rate of savings, that makes sense. Financial markets, right? Poorly developed financial markets limit growth. Legal systems, yeah, property rights. And let me just remind you that we have Thomas Jefferson to thank for these well-defined property rights here in the United States. Thomas Jefferson, and I'm paraphrasing here, he said something like, this republic has no chance of success if we don't recognize property rights and then enforce them in the court of laws. Education and health services, that makes super important sense, especially here as we move through this period of COVID and we're trying to figure out exactly what health services mean and who has access to health services and vaccinations and recoveries and all that kind of stuff. I like this third one there, policies regarding entrepreneurship. I mean, absolutely, that economic growth is fueled by here, let me just go back here. Let me go back here to that third one, an increase in human capital. So we have, let's just take one of my sons, for example, who's gone from a pea brain to, this amazing young man. And so it's the ideas that are young, it doesn't have to be young, but are adults, and it could be kids as well, who have this idea and they say, you know what, I want to pursue this idea because it's going to help us out. This, of course, can increase economic growth. And then free trade. This was a big topic during the Trump presidency about, do we have these tariffs? Do we not have these tariffs? Do we restrict capital flows? Do we not from certain countries, et cetera, et cetera. Now, this is my personal favorite LOS because this is the LOS that says something like, okay, Jim, this is pretty much what you teach in all of your classes. I go like this in my class all the time. I say, here's the economy. It can go like this or it can go like this. What we're trying to figure out is the relationship between stock market appreciation and what kind of economy we have. The author of this reading calls it a sustainable growth rate. So we have to worry about growing too fast, and then we hit the specter of inflation, which is a big concern sometime here in 2021. So let me go ahead and define this. Make sure you understand potential GDP is the maximum output of an economy that can sustainably generate without causing an increase in inflation. So that's really an interesting sentence, especially because there are so many different ways to measure inflation, and there are probably a couple of different ways to measure GDP. But anyway, you get this sense that, okay, we want to grow at this potential GDP so that our purchasing power, oh man, didn't we talk about purchasing power parity in a recent recording, so that our purchasing power is maintained over time, right? We don't want to work really hard for a year and then go shopping and not be able to buy anything, right? We want to be able to buy stuff at the end of the year that's more than what we had at the beginning of the year. Now look at that third circle point. Stock market performance depends on the performance of the economy. Boy, I love that sentence there. And I teach the students in my investments class, and we'll talk at length about this throughout level 2, is that you have this well-diversified portfolio, which means that investors, they tend, not always, but they tend to virtually eliminate unsystematic risk, which means that the only thing left is systematic risk. And let me just remind you, systematic risk is defined as the variability in returns due to changes in economic factors. And so I tell my students, I say, look, when you go out and invest in a well-diversified portfolio, you're betting on economic growth. And then, of course, you're betting that the executives in your portfolio are going to be able to capture that positive net present value that's out there. Now, economists, they love to use some kind of equations to describe the thoughts that go around in their brains. And those of you who are really good at algebra will look at this relationship and you'll see a GDP in the numerator and a denominator and an E in the numerator and the denominator. And you may just mentally cross those out and you'll say, wait a minute, Jim, this relationship is just P is equal to P. And of course, that's true. But this is the way economists think. And just let me remind you that during my PhD program, I do have a minor in economics. So I had a bunch of economics classes. And so you learn about this way of thinking. And it's really, really awesome, because what we're doing is not really saying P equals P. We're breaking down what that P means, right? The aggregate value of equity securities is a function of a handful of variables. So let's start with the red, GDP. So there's the size of the economy. That makes sense based on what we've talked about earlier. And then in green, E over GDP, that's some kind of an earnings yield, right? Some kind of a yield. And that's in green. So think of the green as kind of a return on GDP. And then over in the purple, we have a multiple, right? Price earnings ratio. So the aggregate value of equities. And remember, this is what we're trying to do as good financial analysts, is determine what those future stock prices are going to be. And so this really simple equation tells us that it's a function of the economy. It's a function of the efficiency of the economy, right? Aggregate earnings over GDP, and then some kind of a price multiple. And I know I've said this to you before, but I think it's worth repeating that I always think of the PE ratio as, hey, what's going on on the floor of the New York Stock Exchange, right? $1 of earnings is costing investors how much in price. So super high PE ratios tell us that the investors believe that that stock price is super valuable, and so they're willing to pay for it. Now, what you can do, you can take this equation and turn it into a return relationship using some logarithms. And I won't show you that equation, even though the reading shows it to you, but it's not that too terribly important. But what we're saying here is that if we go back to this relationship here, percentage change in price on the left-hand side of the equal sign is a function of the percentage change in GDP, the percentage change in some kind of an earnings yield, right? The reading calls it corporate earnings share of GDP, and then a percentage change in price to earnings ratio. And that's probably not at the individual stock level, but at the market level. Now look at our bullet points over on the right. Over the short term, stock market performance is affected by all three factors. So this is super important here. Describe that relationship. I really like that. Now, even though the LOS says long run rate of stock market appreciation, we need to know how important this is in the short term, because then what happens in the long term is that the potential GDP growth rate is probably going to equal that rate of aggregate equity valuation. And let me show you a little bit more about what I mean there when we go to this next LOS. Explain why potential GDP and its growth rate matter for equity and fixed income investors. All right, so GDP is important because it controls the effects of inflation in the economy, right? If the economy is going like this, then central banks here in the United States, the Fed, is going to say something like, okay, we love economic growth, but we don't love super high economic growth because there are consequences to it, right? Marginal costs and marginal benefits. And so look at the second diamond point. When the actual GDP exceeds the potential GDP, then we're necessarily going to have inflation, which necessarily means that interest rates are going to rise, which necessarily means that bond prices are going to fall. All right, so that's super important. Let's see, are any of you old enough to remember the 1970s when we had in the United States, 16 or 18% inflation? So we had, lots of inflation, lots of interest rates, and bond prices falling. But then here, look at that indented diamond point. Central bank will most likely impose a restrictive monetary policy, which then means that if we're restricting monetary policy, that's probably going to have a negative impact on stock prices. Now, on the other hand, notice we put this in red. High potential GDP growth results in high real interest rates and higher expected real asset returns, which means then that there's probably going to be an increase in GDP over time. Remember, we're not having inflation here, and that will most likely result in lowering of things like default risk. So the reading calls that improving the credit quality of fixed income securities, in which case bond prices will rise. So that takes care of that part of the LOS about growth rates and fixed income investors. But then let's go ahead and summarize the impact on equity investors. And we took something directly from the reading here. There was a study that was cited between 1946 and 2007, and it noted that our equity price appreciation, so the aggregate increase in prices during that, what is that, a 60-year period or so, was almost exactly equal to about the 7% growth rate of U.S. nominal GDP. So that's important. So let me go back to this one here. So over the short term, those three factors are important, but over the long term, it really comes down to U.S. nominal GDP growth, according to this particular study, but also according to the very beginning of this reading. And that makes sense, and that's consistent with, of course, what I teach my students, that when they own well-diversified portfolios, they're really betting on the economy. All right, so let's move on to determinants of economic growth. So we go to this Cobb-Douglas production function for aggregate output. That's Y, and it's a function of capital and labor. Those of you who've been paying attention to my recordings over the years will note that I love to give examples of my personal history. And so when I was in early college, I worked in a donut factory, and I learned firsthand that if you had better machines and more efficient machines and even more machinery, then we could make more donuts. And then I learned that if you have more employees and better employees and more motivated employees, we could make more donuts. But of course, there's diminishing marginal productivity for both of these, right? Our factory was fixed in size. So if you put 1,000 machines in there, nobody can work them. Or if you put 1,000 workers in there, nobody has any elbow room to get anything done. So of course, we like a production function to be reflective of capital and labor. And then we can put it in that far right to the equal sign format where we're raising K to alpha and L to 1 minus alpha. Of course, alpha is the share of GDP allocated to capital. Think of that as kind of a return to the providers of capital. Think of it as the return to the shareholders. Now, there's not exact one-to-one relationship. It's the return on the physical machinery, but of course, it's the bondholders and the shareholders that have provided the capital to buy that machinery. And then, of course, 1 minus alpha is the return to labor. We're assuming constant returns to scale, which means if we increase input, we increase output, but there's diminishing marginal productivity in there. All right, so let's go on to the next LOS here about capital deepening and technological process. So I said to you earlier that technology is an important word here. So think of this total factor productivity as the productivity or the technology level of an economy. And that technological progress then is the economy's ability to produce more output without throwing more donut machines and without throwing more workers like me into the factory. But we can now have one machine that does the work of 3 machines. Boy, that sounds to me like technological progress. Capital deepening is the increase in the economy's stock relative to its workforce. All right, so this is shown by an increase in the capital to labor ratio. What happens is that it can increase output, but probably is not going to lead to any increase in sustained economic growth. Now, I love this. I love this illustration, this graph. There's a lot of those graphs in my economics days that I didn't like, but this one here is really good. So I like this. I like this productivity. So think of these as production functions or the production frontier. And so capital deepening is going to be a movement along the production function. Remember, we could move along the demand curve back in level 1. Well, that's similar to what we're doing here. And notice that capital deepening, this is good news, right? So we're moving from, let's say, A to B. It's upward sloping. However, technological progress is a different level. We're moving to a higher plane. We're moving up to C. So not only is there a dramatic increase in productivity, but now we have a steeper slope. So at the margins, we're going to be able to make more progress. So I think that's important there, distinguish between capital deepening and the progress. So remember, deepening, movement along production function, but the technological progress is an absolute jump. It's a shift in that production function. So yes, of course, we want to deepen capital, but if we can have one machine do what 3 machines do, that's way better than going from 1 machine to 2 machines. By the way, I was not a very good donut maker back when I was in my early college days. All right, how about growth accounting relations? So sources of growth: growth in labor, growth in capital, and growth in technological progress. All right, so this is summarized by this guy Solo's growth accounting equation, in which we're going to say something like we want to have this growth in technology, that's the A, then growth in capital, and then growth in labor. Now that looks like an awful lot like a relatively complexifying equation, but it's really not. So let's go ahead. Let me just show you a real quick example of what the institute might do on the exam, because look, forecast potential GDP using this model. So this is what we're going to have to do. So here we go. Question STEM gives us labor costs 55%, labor growth 2%, capital investment 2%, and TFP 2.5%. Potential growth rate is closest to. So you really just extract those inputs from the question STEM, throw them into the equation, and you end up with 5.4%. All right, so let's just take a deep breath before we move on here. This is important, right? What are we trying to do as good financial analysts? We're trying to deliver some type of a service to our clients, whatever that service is. In order for us to be able to do this, we need to think like an economist, and we need to be able to forecast potential GDP growth rates. Now, the uses of this growth rate equation: contributions, sources of growth, and potential GDP. So that's pretty much a summary of what I was describing back here. But let's go ahead and move on to a labor productivity growth accounting equation. And this one you'll just love, because it's, boy, look at the advantage. It's simple. And disadvantage is, because it's simple, I'm not quite sure what it means. Let me just show you. Here we have labor force growth rate, productivity growth rate. So what could be easier than 4 plus 6, 10% growth rate? So be able to go back here and use a little bit of multiplication and adding. This was the Solo's growth accounting equation, and then be able to use this labor productivity growth accounting equation. This is what I was saying earlier in the slide deck about the impact of natural resources on economic growth. And this makes perfect sense. I mean, here in the United States, right, what do we have? We have a lot of stuff under the ground, and we have beautiful soil so that we can grow stuff above the ground. And not a lot of countries throughout the world have the land mass that we do here in the United States, and the soil quality and all of the stuff that's under the ground. And so that's probably relatively important regarding adding natural resources into a model of economic growth. So human capital, raw materials, public capital, quantity of labor, technological know-how, ICT, information, computer and telecommunications, and then non-ICT. So there's a good old mathematically expressed equation down at the bottom. So the next part of the reading then describes the categories of natural resources, so renewable and non-renewable. I'm guessing that you don't need me to go through and explain those because, of course, in the last 20 or 30 years, this has been a super hot topic, not just in the United States, but outside and including the entire globe. A couple of important things to take away from this slide. So look at the first diamond point. Countries with more natural resources, more likely to experience high economic growth. However, this doesn't always have to be the case. Some countries that have lots of natural resources may have some restrictions. Maybe they're natural, maybe they're unnatural restrictions that prevents them from achieving high economic growth rates. But those countries that are resource poor, they can always trade. So look at that last diamond point there. Access to natural resources is crucial for economic growth, either through the development inside of the borders or trading outside of the borders. Yeah, there's this concept of a Dutch disease as an economic term, describes the simple fact that domestic currency can appreciate because this country has so much natural resources. So they're exporting, think of a country that's rich in trees, so they're cutting these trees down and exporting lumber. And so this is a good thing. But then what happens is that the rest of the economy suffers. And I can't help but think about my favorite country and my favorite example back in 2008 financial crisis of Iceland, when, Iceland for thousands and thousands of years have pretty much been fishermen and fisherwomen. And so all of a sudden they decided to become bankers. And you guys know what happened in the 2008 financial crisis. If you don't know what happened to Iceland back then, it's really a fascinating story. One day the government showed up for work and said, "We're not doing anything." And they had to be bailed out. I think it was the IMF that bailed them out. But look at this Dutch disease ending there, becoming globally uncompetitive. All right, so this is a problem. What does that diamond point say? The presence of natural material in some countries may restrain economic growth. Labor force. Okay, what do we know about labor force and sustainability of economic growth? Of course, if you have more people, then you're likely to have growth in the economy. How about some labor supply factors here? This is another series of slide decks that I'm going to call just regular old common sense. So demographics, right? Younger population countries have higher potential growth. That makes perfect sense. Labor force participation. This was a big deal in the United States during the George Bush presidency, and then the Barack Obama presidency, and then the Donald Trump presidency. This labor force participation rate. Sometimes it was going up, sometimes it was going down. During the Joe Biden presidency, there hasn't been much talk about this, probably because of COVID. Immigration, boy, this is a huge issue in the United States, and average hours worked. Here's another one of our good slides that I would recommend. Go ahead and take your phone out and take a picture of this and have it available to yourself. Factors influencing economic growth. This is a good summary of what we've talked about here. Physical capital, human capital, technology, and then added is the purple down on the right, public infrastructure. And so, of course, we need roads and bridges and municipalities to be run efficiently. And I like that last circle point, improves the productivity of private investments. All right, so let's take a look at some theories of growth. Let's look at this classical model that goes all the way back to 1800, I believe, in which, notice the diamond point, the arrow point I have over over on the right. Production function in the classical model is simple, and it consists of a labor input. So you have me working in the factory, but there's no factory in 1800. There's just land, and land is a fixed factor. So this classical model, remember, it's classical, which means that it's not recent. And so think about 1800 and think about what life was like in whatever country that you're living in right now. What was life like in 1800? Far different than it was, far different than it is today. But some important parts of this model that we can use, of course, we can use this to build on newer models. So this model suggests that real GDP growth is really just temporary. When the real GDP per person growth rate increases, then a population explosion will bring it back to a subsistence level. All right, so this is what this Malthusian theory was based on. The ideas back in 1800 that if population surge, there's going to be too many people. So look at the third bullet point. An increase in population negatively affects economic growth. Look at the last one. Standard of living remains unchanged even with technological development. So now look at what we put down there at the bottom in smaller font size. It fails for a variety of reasons that we just described, but from an economic standpoint, and this might be a really good exam question, because technological progress has exceeded, in almost all cases, the impact of those diminishing marginal returns that we've talked about throughout the slide deck. All right, so this model fails for a variety of reasons, which means then that there's probably something that came after it. So the neoclassical model goes back to the late 1950s. Economic growth and growth in real GDP depend on exogenous technological progress. All right, so this is important. Remember, exo means outside. So progress that occurs from a technology standpoint out there is going to be pulled in to the economy, and then we're going to experience this economic growth. So look at that fourth circle point. Long-run growth rate per capita is related to the rate of progress, right? Population growth. So even this neoclassical model relies on this idea about population and population changes. And then it adds, of course, a savings or investment rate. And that's super important addition to this model because, of course, companies are not going to have access to capital unless you or I save. Now, when we save, that might mean we go down to a bank, or it might mean that we buy shares of stock in Johnson & Johnson, let's say 20 years ago, and now in 2020, Johnson & Johnson has a COVID vaccine. So see how the savings 20 years ago, and then the technology improvements over time, and then boom, we have something here, and this vaccine in 2021 has allowed the economy to continue to grow. Now this neoclassical model, look at the last circle point there. Per capita incomes of developing and developed countries converge over time. So that's an important part. I'm going to come back to that here in just a minute. But let's go ahead and take care of this endogenous growth theory. Now remember, endogenous means, origination from within, so that instead of us pulling the technology in from the outside world, what we're going to do is develop it or evolve it inside. So look at the two indented bullet points, right? Depends on the ability and willingness of people to innovate. Oh my gosh, so what do we have? And this is true not just in the United States, but throughout the world, the ability and the willingness of people to innovate. I mean, this is what drives the free enterprise system. I saw a great example of this in the 2020 Summer Olympics, which of course occurred in 2021. There was an athlete who was some type of a gymnast when she was little, and some type of something else, and she had a displaced hip, And so she got in a canoe and she won a gold medal in a canoe because she had this problem. And so the ability and willingness of people to innovate, of course, humans have a natural ability and willingness, to figure stuff out. So increase in population positively affects economic growth. So that's an important one. Look at that LOS. Compare these. So that's an important comparison. And then also this function represents a straight line, unlike the neoclassical production function, which is a curve. So let's get back to this idea of convergence. It's the idea that developing countries can catch up. So we can have absolute convergence in which they absolutely converge. We can have conditional convergence in which convergence depends or is conditional upon some things that go on in the economy. Like this absolute convergence kind of means that, those countries over there, they'll just catch up because they'll figure stuff out by watching us, right? And we'll help them out. We're happy to help them out, and they'll just catch up. But now this conditional convergence tells us that, inside of the economy, we need some conditions to hold true in order for those countries to catch up to developed countries. And so look at those examples: equal savings rates, population, and production function. That's probably the most important. Club convergence, this is an interesting kind of a scenario. It tells us that, there are different levels of developed countries. And so there's convergence between probably the rich countries and the middle income countries. They'll converge. But the poorer countries probably are left out. They will not converge. And so this is the non-convergence trap. These countries are not in the club, whatever that club theory means. Now, how does convergence occur? Well, this should make perfect sense. Deepening and accumulation, adoption of technology. So this is what we talked about just a handful slides ago, is that those poorer countries, those developing countries, they need capital deepening, they need capital accumulation, and they need technology. And so there's a good old illustration of, look at the relationship between, just pick the bottom two, Germany and Canada. You could probably say, they look pretty similar, right? If not virtually identical. And then look at New Zealand and Japan, they're somewhere around. So you could see convergence going on there. But look at Kenya and India and Ethiopia. Clearly, during that 20-year period, there's not a convergence. Now, of course, we can't have a conversation about the economy without saying, okay, there are entrepreneurs, there are innovators, there are financial analysts, there are executives who invest in positive net present value projects. We can't have this conversation because by ignoring that other entity that's out there, governments, right? So how can governments, what role is there for governments to play to provide incentives? So this LOS reads, provide incentives. Promote startup of new businesses, right? Encourage existing firms to expand, and discouraging firms from moving to other countries. That's an interesting one. So all the stuff that we've talked about that are important in terms of labor and capital, the government ought to come up with incentives to promote growth rates in capital, growth rates in labor force, so that, and look what's important down there, and what is that, the third diamond point, provision of incentives by governments for spending on R&D. All right, so this is exactly what I was talking about with Johnson & Johnson. It's not true just with the COVID vaccine, but it's true with all sorts of research and development. And it could be something as simple as R&D on how Jim can make a better donut. I think I consumed more donuts while I was working there than I actually made. All right, here's a super simple slide. Growth in an open economy, trade and finance and cash flows freely, right? Open and trade-oriented economies grow much faster than closed economies. Impact, whoops, sorry about that. Let's go ahead and do this last one here. Impact of an open economy on economic growth. I bet I bet we know this based on not only the things that we've talked about just today, but just regular old knowledge of reading the Wall Street Journal and taking classes over our lifetimes. So countries can adopt technology, right? International trade increases competition. Access to international market is important. Oh boy, let's not restrict domestic savings. Companies can allocate resources. Yeah, I love this one. I'm a great asset allocator. And so what we need to do is make sure that we specialize in those industries in which we have an expertise. And so I think that takes us through this reading. Once again, I would say that all of those LOSs that have the 3 letters GDP in them are probably the most important, because from a test creating standpoint, I'm guessing that the CFA Institute is interested in us not becoming economists, but thinking like an economist, so that we can help solve an investment problem. And solving that investment problem includes being able to not only understand GDP and the economy, but be able to forecast GDP.